Hi, Gary and Kevin here, and this is our second quarter market and economic update. I'd like to start off first with a quote from August 12th Barron's article, and this is from a gentleman named James Paulson. He's the chief investment strategist with Wells Capital Management, and he says, "The bull is not over yet. The market is currently just digesting a huge move in the stock market, a repricing of the bond market, and the Fed's move toward tapering. In the long run, economic momentum and confidence in the economy will be strong, but higher yields and tapering will keep a lid on it." And so, he's kind of saying generally what folks are saying out there, but we really are going to concentrate on three things today. The first is about this Fed tapering. What is this going to do? What's the effect of this over the next quarter and next year, and what will happen there? The second is interest rates. We had a really bad quarter for bonds in the second quarter of this year due to some remarks or misremarks, however you want to look at it, by Federal Chairman Ben Bernanke. And then finally, there was this really big difference in the market rates of return for the international markets, equity, the emerging markets, and the U.S. domestic markets. In fact, it was about 20%. And I want to start there with Kevin and ask you, when you look out there and you see what's happening today, and then you kind of look at your crystal ball out in the future, what does that say to you about what's happening here domestically and as well in these international emerging markets?
Well, you go back to coming out of the recovery, emerging economies were in pretty good shape, especially vis-a-vis, the Asian crisis of the 90s. Yeah. The most recent experience, with the inflation being tame, commodity prices being down, that's affected, a lot of the export-related emerging economies. Right. Korea and Taiwan are still export-related economies. They're affected because of Europe being in a recession and our growth being sluggish and tepid at best. We're seeing now some signs of Europe coming out of a recession, just like Mr. Paulson's comments there were largely indicative of kind of the general consensus. You're pretty much hearing that they feel that not necessarily the debt woes and some of the austerity things that Europe has to deal with, but they're coming out of recession. You look at the last month of what the Italian stock market has done and what the Spanish stock market has done, and the interest rates on those two countries coming down as well in terms of the perceived risk. So that's a positive. In the U.S., you're seeing further signs that maybe cyclicals are starting to come back now, and not just being utilities and consumer stocks. So if you think about the whole world complex, then you might very well see further recovery in Europe, possibly in emerging markets as well, and the U.S. continuing to trudge forward if this expansion and this growth of tapering actually occurring and the economic activity, the baton, if you will, being taken by the economy as a whole.
Yeah, and so there's always, there's numbers that are happening every quarter, every year on what affect the markets, and the first one we always look at is unemployment. Unemployment was 7.4% in the latest numbers in July. Came out 162,000 new jobs, but one little disturbing part of that was the fact that there was a 13-year high on part-time jobs being part of that number. Now we have come down by 0.8% from a year ago when it was at 8.2%, so that's slowly recovering. Inflation has not been an issue. It's been benign. It's been staying under 2%, so luckily we're not looking at the horrible things that happened back in the late 70s with hyperinflation, stagflation, and so forth. Third, consumer confidence is up. It's the highest it's been in 5 years. And a lot of times you see markets coincide with that. Consumers become more confident, they buy more stocks, and you'll see that take place, and so forth. But finally, there's interest rates. And interest rates were kind of going along there for a while fairly steadily, and then some remarks or misremarks, or however you want to look at it, on May 22nd were made by Ben Bernanke when the 10-year Treasury was at 1.6%. And now we're sitting here roughly a little over 2.8%. There's been this huge rise. Second quarter, really horrible rates of return for bonds. And I'd like to ask Kevin again about that. What effect, again, does that have on our economy, on consumers, on what's going to happen going forward here?
Well, rising interest rates is good for retirees and consumers because it gives you more interest income. From an investment standpoint, we've all been expecting rates to go up, for the last 5 years. Right. It's not going to stay for zero forever. The Fed has been waiting for the opportunities where they felt they needed to come up from behind the curtain to begin to kind of trial balloon the market to
Yeah.
let it know. And just like why we use this quote from Mr. Paulson is that, you know, the Fed's trying to put that out there so the market can kind of recalibrate and take that into account. That's why you've seen the volatility over the last month, but it's been reasonable. The stock market's trading roughly 3% below its peaks with this last kind of rise in interest rates. From an investment standpoint as well, you know, obviously, like we talked about last time, you want to monitor your maturities. I mean, because if you own a long-term bond and interest rates go up, you know, you'd rather have owned a short one and have it mature and be able to buy a higher coupon. So, you know, what you're seeing a lot is people being in shorter, moderate duration, or if the economy and the world economy is still improving, then a lesser rated company that pays a higher interest rate where, you know, it's worthwhile to take the credit risk instead of the duration risk.
Right.
You know, there's some things you need to be considering as an investor.
Right. That's perfect. Last word. I think what you're going to see here in the next quarter is more discussion about who's going to replace Fed Chairman Ben Bernanke when his term is over in January 2014. Now, there have been two candidates have come to the fore. The first one being Janet Yellen. Now, she's the current vice chairman of the Fed, and she supposedly is going to take a softer view, not taper as quickly if she does take over the Fed chairman, versus the other individual who is Larry Summers, former Treasury Secretary, and he's purportedly to be more aggressive, you know, more of a hawk on, you know, pulling the punch bowl away and reducing the tapering more quickly. So I think we might see, you know, maybe three different voices now causing problems in the markets. Not that we need this, but at least it'll be over by January with the Fed. So wanted to finish up and say we're happy to be able to bring this to you this quarter. Hope you have the rest of the summer is great, and we'll see you next time.
Talk to you soon. Thank you.